Good afternoon, everyone. This is Antonio here at Procyon Partners. I am a senior portfolio manager here. Thank you for joining our webinar. I'm going to introduce some of the partners we have today to talk to you in just a moment. But first, just tell you a little bit about the webinar. Essentially, the title of this webinar is the 60-40 balanced portfolio in 2021 and beyond. We're going to go through a couple of ideas and a couple of iterations. But before we do that, I just wanted to allow my partners to introduce themselves. Mike, why don't you go ahead and do that first?
Thank you, Antonio. Michael Kelly. I'm a partner here at Procyon. I work in the Virginia Beach office, manage this office, and I assist our clients in developing and implementing financial plans and investment strategies to help them achieve their goals.
Awesome. Thanks, Mike. We appreciate that. Glad to have you on as a partner and as a wealth strategist. Also, Kevin, why don't you go ahead as well?
Hi, everyone. My name is Kevin Catale. I'm an investment analyst on the team. My role focuses on investment manager research, portfolio construction, asset allocation, and performance reporting. Prior to joining Procyon, I graduated from UConn with a bachelor's in economics, and I also graduated from Sacred Heart with an MBA and a master's in finance.
Great. Thanks, Kev. As we always say here at HQ, Kev's always got his nose in the book. So thank you very much, Kev. We very much appreciate you joining us here today. So today's webinar is a little bit different in some sense, but really we're going to focus on sort of a theme rather than focusing on current events, with pandemic and these kinds of things. We thought we might turn it around a little bit and talk a little bit about some strategy, investment strategy. And so ultimately, what I'd like to do is define for you really the title of the webinar, talk a little bit about what that means, break it into pieces, and then later on we're going to get into how it applies to clients, and then we're even going to look at some of the research our analyst team has done through Kevin. So start off with 60-40 portfolio, 60-40 all-weather portfolio. 60-40 really refers to the percentages that you have in certain asset classes. So 60-40 normally would be 60% equities, 40% in bonds. Those are some very traditional asset classes and some very traditional investments that high net worth investors and investors around the world have been using, especially in the US, for many, many years. And I would also say that the 60-40 portfolio really represents what I would consider to be a balanced portfolio, and that can be in a range. So 60-40 doesn't, if you're 55, 45, maybe that's what it is, but I think it would run the gamut anywhere from 60-40 in equities and bonds all the way over to 40-60, which would be bonds and equities and anything in between. And so the core of many investment portfolios is this 60-40 balance. 40% generally serves as a bond component. That's the component that's sort of the ballast. It's in there really to adjust for risk measures. We all know that stocks can go up and down and that the returns on stocks are unpredictable. So the bond portion has been behavioral as well as tactical over long periods of time, and it has worked well. If you go back, over history, 2008, before that, the early 2000s, early 90s, and then into the 70s, you can take a look at how balanced portfolios have served as a cornerstone for both individual investors, families, as well as institutions. And so there's always it's always a good time to kind of take a fresh look at how that's going. And since we've had this pandemic, we've had massive fiscal stimulus, we've had trillions of dollars printed, and now we're in a global economy. We're always taking a look to make sure that, in the 60-40 portfolio or in any balanced portfolio where we're diversifying and we want to have different asset classes, that we're using all the asset classes available. And since we're, an independent firm, we're a fiduciary, it's our job to really always look for those kinds of things and bring those to fruition through our investment committee, through our process, and then ultimately to our advisors and clients. So over long periods of time, I think what has worked well, if you think about it, the return that comes from the 40% of your portfolio, the return itself, the return expectation is really driven by the interest rates and maturity of that 40%, because those are fixed investments in general terms. 15, 20 years ago, you could buy a fixed investment at 4 or 5%, and that would last you 10 or 20 years, and that would serve its purpose in the portfolio. As we all know, interest rates have gone down. In many, many parts of the world, interest rates are below zero. They're actually negative. That happened for a brief moment here last year in the US, but didn't last more than a day or so. And so ultimately, we've got interest rates that are still positive here. So when we look at those rates and we look at that asset class, we really want to ask ourselves what the expected return from that asset class is, and decide whether or not we think we should continue to invest the same way that we have, or if we should start to think about it differently. There's a couple ideas that we're going to get across today. But I want to sort of bring this really quickly over to Mike Kelly. If you don't mind, Mike, talk a little bit about, 60/40 clients and maybe, a balanced core holding and how that applies in certain situations, and sort of what are the conversations that go on around that these days, if you don't mind.
Sure. Well, as you mentioned, the 60/40 portfolio, we view it as a balanced portfolio with some flexibility, whereby we can be at 60% in equity all the way down to 40% in equity. I think it's easier on the individual side to talk about who's not maybe an appropriate investor in that kind of a balanced portfolio. But before we get there, I think it's important to differentiate between an institutional investor, which we work with, and individuals. On the institutional side, the 60/40 portfolio is, and when I say institutions, I mean, charitable organizations, endowments, and pension plans. The 60/40 portfolio is a popular portfolio because of the risk management that's involved, and typically a longer to intermediate time horizon. Okay, and when developing portfolios, risk tolerance and time horizon are paramount. The institutional investors, we take an active role in assisting them in determining what's the right allocation for them, but that's determined through typically an investment policy committee, which meets once a year. And so those portfolios tend to not have that much flexibility in terms of, we sit down, we determine what that allocation is, and then we might make some tactical changes, which I'll discuss in a moment. But on the individual side, because again of that flexibility that we can overweight or underweight the growth versus income side of the portfolio, it is a very large core component to the majority of our client base. But if you are an early investor saving, monthly and looking for pure growth, maybe it's not right for you. But obviously, more discussions need to be had. But also, we work with folks that have very large investment portfolios. They draw very little from that portfolio, and in those cases, they don't even need to take as much risk as is inherent in that 60/40 or balanced portfolio mix. But that being said, on the individual side, there's a lot of flexibility that we can bring to the table. And I know we're going to get into some details later, but when you're looking at that growth portion of the portfolio, there might be times where it might make more sense to be invested in more value-oriented investments versus growth-oriented investments, whether we want to overweight or underweight in large cap or small to mid cap. I mean, there's a lot of flexibility there. We at our firm, we focus more on the larger bucket of equity versus fixed income, and then determine what are the best pieces in there, especially like, let's say, bonds today, which are fixed income, which is the most, I think, challenging because of the interest rate environment that we're in. How long of a maturity or duration are we looking for? What quality investments? That being said, I mean, there have been times where we might use alternative investments, and we're looking at more and more at these types of investments these days, such as structured notes or private equity, or even on a simpler scale, using traditional investments as alternatives for traditional investments, such as dividend-paying stocks for bonds, which I know Kevin will get into later. But all of this is determined on an individual basis. So even determining the span of how quickly we move maybe from a 60% equity portfolio and reducing the risk over to a 40% equity portfolio in a potential contracting and economic environment, that is determined by us on an individual basis with our clients.
Right. No, I think it's, absolutely, as advisors, we're sitting with each individual client. We're really customizing the approach to what's most appropriate for them. That's exactly correct. And we've got all these tools really available to us here. So one of the biggest pieces is, when our advisors, I chair the investment committee here at Procyon Partners, and when our advisors come to us and say, here's the situation with a client, we're trying to construct this portfolio, what's the correct asset allocation? So I'll take a minute just to describe sort of how we arrive at those allocations to begin with, so that you can we can follow that thinking when it comes to introducing new things into the portfolio. So, ultimately, what you want to do is you want to think about asset allocation as efficient use of assets, efficient use of resources, and making sure that the risk inherent in those assets is appropriate for your time horizon, as Mike described. When you take a step back and you look at it from the big picture and you say, gee, if I could just go out and buy 10% bonds that paid me 10%, for the next 50 years, why would I have to buy stock? And that would be a good answer. The problem is when that is occurring, like it did in the early 1980s, stocks are going up. And so you're always pulled and drawn to what the actual better performers are. So, I want to talk a little bit about our process, which is that we've got 7 voting members on our committee. Our committee is open to all advisors, and we've got 7 voting members. And what we do is we take a survey each quarter to talk about our current asset allocation. And it's really more about overweights and underweights. It's less about what, John A. Smith is doing with their investments. It's more about, from a big picture point of view, how do we feel about investments going forward? And so we take a survey, we go through that survey, we have the debate, and we ultimately come up with an asset allocation that we think takes full advantage of the marketplace. And when you're faced with an asset allocation decision, like, should I buy 1% bonds or 0.5% bonds? You start to think, well, am I really wasting my time on this decision here? Of course, the answer is no, because bonds serve other purposes. But when you're thinking about where can we add value to client portfolios, we really focus a lot on investment sourcing. And so we're big believers that in our committee, that ideas can come from anywhere. They can come from advisors, they can come from analysts, they can come from a portfolio manager like me, they can come from a manager in some other fashion, they can come from outside the walls. So we want to remain open to discussing these different ideas. So ideas come in all different ways. Also, ideas are produced from within. So when we go through our due diligence and we look at our portfolios and what we're managing, we want to look at the asset classes and say, well, there are some asset classes that are not represented here. Let's do some research. And so what we've done is we've actually formed, aside from our main investment committee, we've got 2 subcommittees. One of those subcommittees' job is really to dig in deep into those managers. We call that the manager research group. That's something that we formed in the last year. We've got a partner, we've got a senior advisor on that. We've also got 2 of our investment analysts. One's a senior analyst, and we've also got another investment analyst. So we've got several people on this committee, all of which are linked into advisors as well as our major investment committee. So we can feed information all around and where it comes from. So, recently we did a search, and I'll let Kevin get into that in a minute. But if you think about the genesis of our new search, it comes down to, if we're dealing with a balanced portfolio, and let's call it 60-40, as we have in the title of this webinar, maybe it should be 50-40-10, or maybe it should be 60-30-10, or 60-35-5 or something. And so what we start to do is to fill in the gaps there. And the first thing we do is to find investments that we think might fill in those gaps. So some characteristics about those investments that are maybe outside the norm are going to be things like, long short funds, non-traditional investment strategies, things that will derive return outside of the normal return stream of just traditional stocks and bonds. And so we go through that process, and we asked the manager research group to do that over the last several months, and they've done a lot of work on that. So, Kevin, I wonder if you can just give me kind of an example of the search you went through recently, and mention some of the investments that we were looking at.
Yeah, sure. So as Antonio said, the group's in charge of performing due diligence on key asset classes to find quality managers for use by the firm. So this process really starts with a quantitative screen where we narrow the universe down of the asset class to make it a little easier to choose from. From here, the committee will select a few funds to take a deeper dive into. And this will kind of be the part where the committee looks into the qualitative side of the fund. And what that is what is the underlying strategy of the fund, or what strategy or techniques is this fund manager using that's different or unique from other funds. So we'll likely set up phone calls with portfolio managers from each of the funds we'd like to take a deeper dive into. And then based on those results, we'll take the funds to the broader investment committee for vote to add to the list. And this process turns out to be very effective because a lot of the funds in all our alternative search are very different, even though they're in the same asset classes. An example of this was during our search within the non-traditional bond space. We ran into two funds, one Carillon non-traditional bond and BlackRock non-traditional bond, which while they're in the same asset class, they were totally different strategies. Carillon was a more conservative investment style, while BlackRock was more alpha seeking. So it kind of goes to show how the process can be effective and kind of inform us on what exactly we're adding to the list. And we ended up adding both given the differences between the two and how they complement each other.
Yeah, no, I think that makes a lot of sense. And ultimately, what we want to do is, when Kevin talks about our list, what we have is an internal recommended list of stocks and funds. And so a lot of the non-traditional asset classes that we've done research on, and I'm thinking about hedge funds, private equity, structured notes, long, short, commodities, these kinds of things. Even some real estate can be considered in that asset class. Traditionally, a lot of those didn't have access unless you were a qualified investor with 5 million or more in liquid assets. Over time, that has been democratized. And what we're now seeing and able to do research on is some of what Kevin was discussing, which is that, we can find a mutual fund wrapper around some of these strategies that has been working quite well. We pick apart the manager, the strategy, and the wrapper all at once because, again, we're agnostic to what goes in the portfolio as long as it's the best for the client. So I think access is one of the things that has slowed down the integration or the investment into alternative asset classes. And I don't just mean alternative hedge funds. I just mean outside of, the typical and traditional stock and bond investments and maybe even the traditional mutual funds. Years ago, you'd have to be an ultra high net worth investor in order to gain access to some of these things. Simply because of the regulation that has gone on around it. Since 2008 and 9, there have been lots of new regulations that came out with regards to some of this, and what it's actually allowed some of these firms to do is to shrink down the minimum investment for some people. Now, that has worked in the sense that we're able to now scatter that across different portfolios and different sizes for different walks of life. And so that means a lot to us and a lot to our clients as we kind of move through this. I wonder if there's some specific examples there, Kevin, and I wonder if, Mike, if you might give an example and describe walking through a structured note with a client, because a structured note is essentially, a derivative contract, but it has within it some guarantees and some other things that you've been able to work through. So I wonder if you might just kind of describe that for us so that we can get a sense of how that's working.
Certainly. Well, the first thing that I would say is that when we're with all of our alternatives and specifically structured notes, the decision to bring them to our clients is typically a tactical decision based on what's happening in the current market environment or economic environment. So again, those are basically focused on a particular time period and have an end date, let's say. Okay. And to your point, they've been, structured notes specifically have been around for a very long time. They have typically had very high minimum investment requirements, in the millions of dollars. Those minimums have come down into the hundreds of thousands of dollars. But when we talk about these minimums, we're still talking prior to our use of these investments, but we're still talking about things that are created by someone else for the broad, market and are available to someone in that minimum range. We work a little differently. We basically come to the table as, Procyon, we are the multi-billion-dollar client, okay? And so when we use structured notes, we're not buying something that's available on the broad market. We go to certain resources that we have, and we basically explain what are the parameters that we want, and what are the protection, what's the protection that we want, and what's the type of return that we want. And then if it's available, we have it created for our clients. And then to your point, Antonio, we're able to basically chop it up and put it into portfolios, which is also specific to that individual client that it being appropriate for that individual client, and that's communicated to the group by the advisor working with that client. That all being said, we have structured notes that we use as growth investments, and we have structured notes that we use as income alternatives or surrogates, basically. The growth is a little easier in the sense that we're looking for whether it's a particular individual stock. We've created a structured note that was tied to the performance of, say, Amazon, Target, and Walmart individually. And we've also created structured notes on the growth side that are tied to sectors, the financial sector, energy sector when they were depressed, let's say. And in those cases, what we're looking for is to participate on the upside. And typically, when you structure these notes, the participation is greater than 100% of the lowest performer of the group that you've associated with. Okay, so you're typically getting, like I said, more than 100% of one of those holdings on the upside. And right now, going into a growth contract, we're not going out beyond a 3-year maturity. But while you're exposing yourself to or giving yourself the opportunity to more than 100% of the upside, we're also able to create some downside protection so that, for example, in the let's say the Walmart portfolio, Walmart, Amazon, and Target, our clients, should the worst performer be down less than 20%, our clients get their money back. So that, we have a little bit of downside protection and participating greater than 100% on the upside. Where we see a lot of value in these structured notes right now is on the income side. Okay, and that the structured notes that we own right now, number one, one of the challenges these days is liquidity. If you're in a AAA corporate bond portfolio, the 20-year AAA rate is less than 2%. So if you want to lock your money up for 20 years and have very, very, very high quality, you're getting a less than 2% return with a lot of downside risk in the short term, very little liquidity. Our structured notes typically mature within a year to 18 months. And right now, the potential yield on those is between 11.5% and say 8.7%. So, not to replace bonds, but they can kind of boost the average yield on a traditional bond allocation. Again, this is to be discussed obviously individually with a client to make sure it's appropriate for them, but that's where we see some significant value, because the risks, in our opinion, the risk associated with a 20-year time frame, let's say, versus an 18-month time frame is very attractive.
It makes sense. I mean, ultimately, like you said, Mike, we're not abandoning bonds. We're not abandoning stocks, the traditional way of doing it. Bonds still serve their purpose in the sense that, if the stock market is selling off very, very quickly, your bond portfolio is probably rising a little bit. Now, we're going to get into correlations in a minute, but just to kind of go back to what you were saying, I think what we're describing here really is how to enhance balanced portfolios. And so, when we talk about structured notes and we talk about long short and we talk about private equity, really what we're talking about is how do we enhance the return of what you already have. And there are a few other forces in the market that are creating that. And so, Kevin, I think you're going to talk about that for a minute. So why don't you go right into that? And I've got some slides for you here as well.
Yeah. So, given the current market environment, a lot of firms have been looking for new ways to generate more yield. The one solution I've seen put forth was taking a percentage of the fixed income, so that 40 out of the 60-40, towards high dividend or high quality dividend growers. So rather than using an alternative investment, it's kind of rethinking the 60-40 structure and kind of shifting those percentages around. So why does this make sense and why can it work? If you could pull up that first chart for me, Antonio, kind of showing the long-term yields and kind of the trend it's been on since 1981. You'd see, yep, so you can see here where we were in 1981 compared to where we are now. Yields are very low. And it makes it hard to kind of generate a high yield one, and it's tough to justify holding the asset. In addition, given to the reopening of the economy and higher than expected inflation, there's a greater risk for capital loss, given that rates could go higher. And then on top of it,
I'm in for just one second, Kevin. I
Yeah.
don't mean to interrupt, but if you look at this typical interest rate cycles, we all know a lot about stock cycles, right? Equity cycles, recessionary cycles, the business cycle. We pay a lot of attention to that. But bonds have a cycle as well. Typically, interest rate cycles run in 30-year increments. I would say, if the housing crisis had not occurred and maybe even the pandemic had not occurred, this chart would look very different than it does now. We had, a peak of rates in the early 80s. Maybe some of us remember, maybe some of us will ask our parents or our grandparents, but, you were able to walk into a bank and buy a CD or deposit money into a CD in 1982 or 3 for 12 or 15%. Of course, mortgages were 17 and 18%, and treasury bills were, somewhere around the 10 to 15% range. So I want to sort of just frame this in the sense that, these declining yields, certainly theoretically can go below zero and have, but, what we see is longer term, multi-decade cycles for interest rates. So go ahead, Kev. Sorry about that.
Right. Oh, yeah, thank you. And then moving on to that next slide, another thing that's been happening with fixed income and equities is the correlation between the two. Typically, correlation between the two is negative, but currently the correlation is positive, slightly positive. And an important part of holding fixed income is that diversification factor from equities. So since the correlation is positive, it kind of reduces that benefit of holding this fixed income. And then finally, if you can move into that final slide showing my last piece of research that shows the difference between income growth between the S&P 500 and the U.S. Treasury bond, the 10-year. Since 2010, you can see that the 10 years stayed relatively flat, while income within this S&P 500 dividend stocks has been growing. So the thesis here is if my fixed income is producing low yield with a chance of rising rate environment, has a positive correlation to stocks, reducing that diversification benefit, could make sense to use some of that fixed income allocation towards high dividend value stocks. So this is one of the many ideas being put forward that's starting to get some traction. Yeah. That's
great. No, I think that makes a lot of sense. And as we sort of started this off with, what do you do with, 60, 40, 40, 60, 50, 50 portfolio? Really what we want to do is make sure that we keep our bedrock and our foundation solid, enhance it as we kind of go along with different strategies and different things. And given again that we're independent and we've got, everything at our fingertips, we're able to deliver that to the clients. A couple other notes I just wanted to kind of mention here as well is that, we're only going to take about 35 minutes of you guys' time today when we thank you again, but a few other things about correlation. Let's kind of go back here for just a second. So if you look at correlation, correlations do fluctuate over time. And the typical correlation that we're picking for stocks and bonds, or at least that we've all been taught in our multitude of finance and economics classes, especially Kevin, is that the average correlation between these two asset classes is negative. And that means that on a normal day, they're going to be negative. It'll act normally. But when the day is not normal, it doesn't always act that way. So in 2008 and 9, in the financial crisis, correlations went to 1, and almost all the assets went down. The US dollar went higher back then, but corporate bonds, double and AAA rated corporate bonds back then were, trading much lower with stocks. You go into the pandemic and you look at, March of last year and the free fall that asset classes were in. All of that occurred except for treasury bonds. Treasury bonds remained neutrally correlated. But after you kind of get through that, what ends up happening with these correlations, and I'm going to stop this sharing here. What ends up happening with these correlations is that they can be influenced and they fluctuate. And so the first time we really saw correlations go to 1, at least in my lifetime, was back in 2008 and 9 when the Fed stepped in. TARP was produced, the Fed stepped in, they began ballooning their balance sheet from about $500 billion to $4 trillion within a fairly short period of time. If anyone remembers QE or quantitative easing, that's what that was. And so they started to pump money out and print money. As that began to occur, right, rising waters lift all boats, you had a general rise in asset prices. Of course, it didn't happen to the housing market. That was the asset left out, but everything else pretty much went up. Then you fast forward to the pandemic, and what happened over the course of a year or 2 years, or maybe even 2.5 years in the financial crisis, happened within 2 weeks during the pandemic. Everything that we had figured out back then, and we didn't have the banks to deal with this time either. The banks were very, very solid, but the Fed stepped in and said, we know what to do. We've got to put in place some emergency funding mechanisms in order to deal with things. And when you do that, as we learned in 08 and 09, correlations begin to converge, and they all start to go to one because the money, is just going out into the world. And into markets, of course. And so I think what we're faced with is deciding whether or not that is a sustainable economic function going forward. At this point, the assumption is that it is. If the assumption was that it wasn't, then markets would probably be in a different place right now. But I think the assumption is that the Fed can continue to do what they need to do and have shown resiliency in doing so. The government, in Washington, same sort of thing, trying to put forth infrastructure plans and so forth. Well, I will not make any political comments on this webinar. It's probably a bad idea, so I'll keep those comments to myself. But ultimately, it looks like everything's moving, in the right direction. Of course, taxes are an issue, which will jolt markets a little bit. But correlations are important because in order, the whole reason to have a balanced 60-40 portfolio is so that when one thing is going down, the other thing is going up. And vice versa. And so what that does is that allows you to sleep at night, it allows you to keep your peace of mind. And so when we're looking to enhance these portfolios, we're looking at a lot of factors. The sleep at night factor is a big one. Another factor that's gone on in the marketplace, and this is really on the 60% side, instead of the 40% side, the bond side, the equity side, is that there are half as many publicly traded companies today as there were 10 years ago. So what begins to happen, and the ones that are left are worth twice as much. So what begins to happen is, but by just buying the market or by just owning the market, your diversification begins to become compressed. And that's because you have half as many companies available. Now, many of those companies that are gone, they didn't go out of business. They either went private or they were bought by a bigger company. So they still exist. We just don't get to see their stock trading independently. And so what ends up happening is that the scope of available investments in that world where half as many companies are public starts to shrink. So as that shrinks, we have to introduce ways to invest in those companies, maybe that are no longer public because their return stream isn't maybe what Wall Street wants to see. And so there are a couple of factors. There's this very, very low interest rate factor that really plays into our expected returns for a good portion of that portfolio. There's this, really shrinking of available public equity investments that make us look at elsewhere. The Fed kind of stepping in makes us realize that correlations among asset classes will probably remain that way for a little while. And so really all we're trying to do here is take a balanced portfolio and make sure that it remains balanced. Make sure that it remains completely diversified, that we've got alternative asset classes there that we have access to that are thoroughly researched. So I think that was what I would leave you guys with. I just want to make sure that on this webinar, that balanced portfolio is really important. Discuss with your advisor if it's appropriate for you. If we should be introducing alternatives, discuss that with your advisor as well. We're working on that all the time at the investment committee. We really enjoyed giving you guys this webinar. Please send any feedback, any questions to us if you have any. But we will let you go and enjoy the rest of your lunch hour. We thank you very much for your time. Thank you, Mike. Thanks, Kevin. You guys have a great day, and we'll see you again soon.
Our pleasure. Thank you.
Everyone.